Gold just hit $6,000 an ounce. Not on COMEX, not on London. Both of those are closed. But in China, during weekend trading, while the world sleeps, gold exploded $750 above Friday's close. A Chinese bank just warned it may have to suspend all gold trading. Inventories drying up, vaults emptying. Meanwhile, the supreme leader of Iran has been assassinated. Missiles are striking Dubai, U.S. bases are under fire, and the speed of escalation is unlike anything seen in modern history. What happens next could rewrite the rules of global finance. What happens next could force silver to levels nobody alive has ever witnessed. Welcome to Boring Currency FX, the channel where we connect the data no one else is connecting. If you are watching from New York, London, Karachi, or anywhere in between, hit that subscribe button. Consider it like telling an old friend. Trust me, this one is important, because it really is. Markets do not fear events. They fear chain reactions. After gold touched $6,000 in Chinese trading, the focus shifted from price to probability. The assassination of Iran's supreme leader did not simply remove a political figure, it removed the stabilizing authority within a complex power structure. Fragmented command increases the risk of miscalculation, and miscalculation in geopolitics travels fast. Energy markets responded immediately. The Strait of Hormuz carries nearly a fifth of global oil supply. Iran's proximity means even the threat of missile activity increases insurance costs. Doubling or tripling premiums may seem abstract, but it ripples across freight, refining, and consumer prices. Entrepreneurs, even in tech or services, feel it through logistics, fuel, and operational costs. Central banks face constraints. Inflation could surge due to energy shocks, but tightening risks recession. Monetary tools lose power when real-world disruptions accelerate. Gold becomes the refuge. Escalation pathways include regional involvement, naval engagements, or even nuclear tests. Each scenario amplifies volatility. Leaders who ignore low probability, high-impact risks put their organizations at risk. Scenario planning, modeling outcomes in advance, becomes essential. The interconnectedness of energy, shipping, insurance, currency, and credit means one event can cascade into systemic instability. Serious executives hedge exposures, strengthen cash buffers, and secure alternatives. Knowing volatility is no longer just a headline, it is the business environment itself. While attention remained on gold crossing $6,000, silver quietly faced even greater structural stress. Unlike gold, silver is smaller, dual purpose, and far more sensitive to concentrated demand. It is both an industrial metal and a financial asset, making it vulnerable during systemic crises. Industrial demand surged alongside financial demand. Missiles, satellites, and communication systems all rely on silver. Solar panels, electronics, and military equipment create additional consumption. Mining cannot adjust quickly. New mines take years to develop, and many operations are byproducts of other metals. The gold to silver ratio compresses during crises. With gold at $6,000, a compression toward 30.1 suggests silver could reach $200 per ounce. This is not speculation, it is simple math. Liquidity strain amplifies volatility. Physical silver is scarce, futures are leveraged, and short covering cascades can push prices dramatically higher. Geopolitical concentration adds pressure. A few key producing countries can disrupt global supply through export controls or prioritizing domestic use. Silver illustrates that smaller systems under stress experience extreme swings. Business leaders dependent on narrow supply chains face analogous vulnerabilities. Silver is both a warning and a gauge. Financial stress meets industrial scarcity, and the combination is explosive. That brings us to the final layer. Systemic implications and what business leaders must do next. Gold's surge, silver's structural shortage, and escalating geopolitical tensions converge to create a rare moment in global history. Central banks can inject liquidity, but they cannot replace disrupted supply chains, repair damaged infrastructure, or prevent missile strikes. The result is a repricing of real-world risk. Decision makers must act like chess players, anticipating moves several steps ahead. Hedging alone is insufficient. Diversifying suppliers, increasing reserves, and understanding exposure to energy, metals, and currency volatility becomes critical. The final risk lies in contagion. Financial panic can spread faster than missiles. Short-term trading can amplify systemic weakness, triggering bank-level inventory shortages or forcing forced buying of precious metals. Physical markets may outpace paper markets, creating a feedback loop of price acceleration. For the business community, young entrepreneurs, and executives, the lesson is clear. When core systems fragment, preparedness is measured in concrete assets and strategic foresight, not optimism or wishful thinking. Holding cash, credit, or digital promises is insufficient. Gold and silver act as a store of value when every other system reprices risk in real time. History rarely offers such unambiguous warnings. The combination of geopolitical upheaval, market scarcity, and industrial demand forms a triad of risk that few alive today have seen. Understanding it, planning for it, and acting decisively separates those who preserve wealth from those caught flat-footed. The story is still unfolding, but part one has shown the trigger, the escalation, and the structural vulnerabilities. The next sections will explore how institutions, markets, and strategic decision-makers respond in the hours and days to come, because in moments like these, delay is not an option. Markets do not fear events. They fear chain reactions. After gold touched $6,000 in Chinese trading, the focus shifted from price to probability. The question was no longer whether risk existed. The question was how far it could spread. The assassination of Iran's supreme leader did not simply remove a political figure. It removed a stabilizing authority within a complex power structure. In many systems, the head of state acts as the final decision maker. When that position disappears suddenly, command fragments. Fragmented command increases the chance of miscalculation, and miscalculation in geopolitics travels fast. Energy markets were the first to model escalation. Traders examined the Strait of Hormuz. Nearly a fifth of global oil supply moves through that narrow passage. Iran sits beside it. It does not need to close the strait completely to disrupt markets. Even the threat of missile activity or naval confrontation can increase insurance costs for tankers. Insurance premiums matter more than headlines. If insurers double or triple rates overnight, shipping companies pass those costs to refiners. Refiners pass them to distributors. Distributors pass them to consumers. Within weeks, higher fuel prices begin showing up in food, manufacturing, and transportation costs. Entrepreneurs often underestimate this chain. They focus on sales and marketing while ignoring energy exposure embedded in their supply lines. But when oil rises sharply, profit margins shrink quietly. Freight contracts reset. Raw materials become more expensive. Even digital businesses feel the pressure through data center costs and logistics networks. Central banks then face a constraint. If inflation rises because of energy shocks, monetary authorities cannot easily cut interest rates. Yet if growth slows because of uncertainty, they cannot tighten aggressively either. This creates policy paralysis. The United States Federal Reserve becomes a spectator in such a scenario. It can provide liquidity, but it cannot produce oil. It cannot repair shipping lanes. It cannot reverse geopolitical events. When monetary tools lose power over real-world disruptions, markets search for assets outside the financial system. That is why gold often strengthens during energy crises. However, the situation contains deeper escalation risks. One scenario involves direct confrontation between regional powers. If neighboring Gulf states become active participants, the conflict widens. A wider conflict increases the chance of infrastructure damage: ports, pipelines, refineries. Each damaged facility tightens global supply. Another scenario involves naval engagement. The presence of major military vessels in the Persian Gulf introduces high stakes. A strike on a significant naval asset would not be symbolic. It would force immediate and overwhelming response. Financial markets would interpret such an event as the transition from regional tension to global confrontation. There's also the nuclear dimension. Analysts understand that even an underground test changes perception. It alters the balance of deterrence. It pressures neighboring countries to reconsider their own defense strategies. Capital markets react strongly to shifts in strategic balance because long-term stability becomes harder to model. For business leaders, the important point is not predicting which scenario occurs. It is recognizing that each pathway increases volatility duration. Short conflicts create sharp but temporary price spikes. Long conflicts create structural repricing. Investors calculate risk premiums based on time. A 3-day disruption affects quarterly earnings. A 3-year instability reshapes capital allocation models. Infrastructure investment slows. Expansion plans pause. Cash reserves increase. Entrepreneurs in emerging markets face additional pressure. Currency volatility often follows geopolitical stress. When oil rises, import-dependent countries see trade deficits widen. Their currencies weaken. Imported goods cost more. Domestic inflation accelerates. Access to foreign capital tightens. Even technology startups are not insulated. Venture capital becomes cautious during global instability. Risk appetite contracts. Funding rounds take longer. Valuations compress. Liquidity becomes selective. What makes this moment unique is the speed at which probabilities are being repriced. In previous decades, escalation took weeks to unfold. Today, information moves instantly. Satellite images circulate within minutes. Official statements spread globally in seconds. Markets react before governments finish drafting responses. This creates amplification. Fear spreads faster than facts. Insurance algorithms adjust before diplomatic channels stabilize. Traders reposition before formal policy meetings occur. Yet calm analysis remains essential. Not every escalation becomes global war. Not every missile exchange closes a shipping lane. Markets often overshoot before stabilizing. But leaders who ignore low probability, high impact risks place their organizations in danger. The disciplined approach is scenario planning. What happens if oil reaches $150? What happens if shipping delays double? What happens if credit spreads widen by 200 basis points? Serious executives do not wait for confirmation. They model outcomes in advance. They secure alternative suppliers. They hedge exposure where possible. They strengthen cash buffers. Part 2 of this unfolding story is about contagion. One event triggered gold's surge, but the greater risk lies in interconnected systems: energy, insurance, shipping, currency, credit. When those systems begin adjusting simultaneously, volatility stops being a headline. It becomes a business environment. And in such an environment, preparation separates stability from crisis. While attention remained fixed on gold crossing $6,000, a quieter and potentially more explosive shift was building beneath the surface: silver. Most investors view silver as a secondary metal. It is cheaper per ounce. It is often described as gold's little brother. But structurally, silver behaves very differently. And during periods of systemic stress, those differences matter. The global gold market is deep and widely held by central banks. Silver, by contrast, is smaller and more sensitive to concentrated demand. Its total market value is only a fraction of gold's. That means it requires far less capital to move its price dramatically. In stable times, silver trades in a balance between two identities. It is both a precious metal and an industrial material. It reacts to investor fear, but it also responds to manufacturing demand. This dual nature becomes powerful during conflict. Gold's demand surge is primarily financial. Investors buy it to protect purchasing power. Silver, however, faces financial demand and industrial demand simultaneously. Modern technology relies heavily on silver's conductivity. It is used in solar panels, electronics, medical devices, and high-performance batteries. During peacetime, renewable energy expansion alone consumes record volumes of silver. During wartime or military escalation, additional pressure appears. Missile systems, advanced communications equipment, radar arrays, and satellite technologies require highly conductive materials. Silver's physical properties make it difficult to substitute in critical components. When military production accelerates, industrial consumption does not pause, it intensifies. This creates a structural imbalance. Mining supply cannot adjust quickly. New silver mines require years, often a decade, of development before production begins. Many silver operations are byproducts of other mining activities, such as copper or zinc extraction. This means output depends on broader industrial cycles, not purely on silver prices. If demand spikes suddenly, supply does not respond in real time. Instead, inventories absorb the shock until they cannot. Over the past several years, analysts have noted recurring supply deficits in silver. Annual consumption has exceeded annual production in multiple periods. The gap has been filled by drawing down above-ground stockpiles, but stockpiles are not infinite. When gold surged to $6,000 in Chinese trading, attention focused on physical inventory pressure and gold markets. Yet the more fragile system may be silver's. Because silver's market is smaller, institutional flows have amplified impact. If hedge funds, sovereign wealth funds, or industrial buyers begin accumulating aggressively at the same time, price elasticity becomes extreme. A few $1 billion of coordinated demand can move the market disproportionately. There's also the gold-to-silver ratio, a metric closely observed by metals analysts. Historically, during periods of monetary stress, this ratio compresses. When gold rises sharply, silver often accelerates faster. The ratio has moved from levels above 80:1 in calm periods toward 30.1 or lower during intense crises. If gold stabilizes near $6,000 and the ratio compresses toward 30.1, simple arithmetic suggests silver prices far above historical norms. This is not speculation, it is mathematical translation. But the deeper risk lies in liquidity strain. Silver futures markets contain leverage similar to gold. Many contracts represent exposure rather than physical delivery. If physical demand tightens supply while paper contracts remain outstanding, tension develops between settlement obligations and available inventory. That tension can trigger short covering cascades, widening spreads, and sharp upward spikes. For entrepreneurs and business leaders, the lesson is not about trading silver futures. It is about understanding asymmetric systems. Small markets under stress move differently from large markets. They are less stable. They gap faster. They recover slower. In corporate strategy, this principle applies beyond metals. Small supply chains under demand of shock behave unpredictably. Narrow distribution networks collapse faster than diversified ones. Silver illustrates this vulnerability clearly. There is also geopolitical concentration. A significant portion of global silver production originates from a limited number of countries. Political instability, regulatory changes, labor disruptions, or export controls in those regions can amplify shortages. In a period of rising geopolitical tension, resource nationalism becomes more likely. When nations view certain materials as strategic, they restrict exports. They prioritize domestic needs. They treat metals not as commodities, but as security assets. This changes trade flows and intensifies price competition. The result is a convergence of forces. financial hedging demand, industrial consumption, military acceleration, constrained supply, and geopolitical risk. Unlike gold, which primarily reflects confidence in currencies, silver reflects confidence in both monetary systems and industrial stability. When both come under pressure simultaneously, silver becomes a pressure gauge. Executives observing these dynamics recognize a broader principle. In volatile environments, smaller systems experience greater swings. Businesses heavily dependent on single suppliers or limited raw materials face similar exposure. Silver is not merely reacting to gold's movement. It is responding to its own structural conditions. And if gold's surge represents a warning about trust in financial systems, silver's potential surge represents a warning about stress within the physical economy itself. As gold surged to $6,000 and silver's vulnerabilities became increasingly visible, the implications for global markets and personal wealth management shifted from theoretical to urgent. Part 4 of this story examines the strategic imperatives for businesses, investors, and individuals navigating a world where traditional systems are under unprecedented strain. The first principle is clarity about exposure. Financial systems rely on predictability, on assumptions that markets, supply chains, and governments function as expected. When a central bank halts a major trading operation, or when a country faces sudden military escalation, that predictability disappears. Leaders must identify where their wealth and operations are dependent on single points of failure. This includes concentrated cash holdings, bank accounts exposed to local currency risk, and investments in paper assets that cannot guarantee physical backing. Diversification in such an environment is no longer just about spreading financial assets across stocks, bonds, and funds. It extends to physical holdings, supply chain alternatives, and access to tangible commodities that maintain value independently of currency fluctuations. Gold and silver, long considered safe haven assets, now function not only as hedges against monetary instability, but also as protective stores of real wealth that can withstand systemic shocks. Institutions and individuals who understood this principle prior to the crisis are now positioned advantageously, while those reliant solely on digital or derivative assets face heightened vulnerability. Liquidity management is the second imperative. Markets may gap violently higher or lower in response to real-world events, but liquidity constraints exacerbate risk. Entities with ready access to cash or easily convertible physical assets can act decisively, while those locked into leveraged positions or thinly capitalized operations risk forced liquidation at unfavorable prices. Strategic reserves, whether in currency, commodities, or credit lines, provide optionality in an environment where timing is critical and reaction windows are narrow. The third imperative involves scenario planning and real-time monitoring. Part of the crisis in financial comprehension arises from underestimating interconnected systemic risks. Geopolitical escalations, energy disruptions, and resource shortages do not occur in isolation. Each has cascading effects. Rising oil costs affect transportation and manufacturing. Constrained silver supplies affect electronics, solar energy, and military systems. And escalating conflict raises insurance premiums and credit costs worldwide. Leaders who integrate these variables into real-time monitoring models gain an early warning advantage. They can anticipate bottlenecks, hedge exposures, and adjust operations before the broader market reacts. Additionally, communication strategies matter. In volatile periods, stakeholders, investors, employees, and partners require transparency. Panic and misinformation magnify the impact of real-world events. Organizations that provide clear, rational updates and outline contingency plans reduce operational risk and maintain confidence even as markets fluctuate. Part 4 also emphasizes the role of geopolitical awareness in strategic decision-making. Global conflict, as demonstrated in the Middle East scenario, has direct implications for both financial and industrial assets. Understanding not only the immediate event but the potential chain reactions allows leaders to position assets strategically, whether by securing alternative suppliers, diversifying geographic exposure, or reallocating investment toward more resilient sectors. Finally, there's the lesson of decisiveness. In a fractured system, hesitation can be costly. The speed of escalation in markets, coupled with the physical constraints of commodities like silver, means that opportunities to act are brief. Individuals and institutions must make informed, prompt decisions about acquiring, preserving, or reallocating assets. Delays can result in missed protective measures or forced transactions under extreme pressure. The overarching message is one of proactive preparation. Gold's $6,000 surge and silver's constrained supply are not anomalies. They are signals of a deeper structural realignment. Markets are repricing trust, scarcity, and risk in real time. Leaders who recognize the signals, understand the dynamics of smaller markets, and integrate systemic thinking into their financial strategies gain resilience. Those who ignore the warnings risk exposure to cascading failures that extend beyond paper losses to tangible reductions in wealth and operational capacity. In conclusion, Part 4 underscores that in today's global economy, wealth preservation requires more than conventional investment strategies. It demands comprehension of geopolitical, industrial, and financial interconnections. It requires diversification across physical and digital assets, proactive liquidity management, continuous scenario planning, and the decisiveness to act when systems are under stress. The events surrounding gold, silver, and geopolitical upheavals illustrate a fundamental reality. In a world where systemic shocks can occur with unprecedented speed, preparation and understanding are the only true defenses against wealth erosion. Would you like me to now craft Part 5, the forecast and strategic outlook, completing the full 5-part story with actionable takeaways and projections for markets and commodities?